Today, some of the biggest names in the tech sector sent a warning signal that many retail traders may not notice until it's too late. It wasn't the usual headline-level movement that grabs attention. It wasn't a massive sell-off or a sudden rally. It was something quieter, but far more meaningful. If you stay with me until the end, I'll show you the exact behavior inside big tech that often appears right before the market makes its next significant move. The trading session started normally, with tech stocks opening slightly higher, but the tone changed quickly. Instead of clean buying or steady momentum, we began to see signs of hesitation. Some large-cap names that usually drive the Nasdaq higher slowed down unexpectedly. For companies that dominate market direction, hesitation like this sends a message. It tells us that confidence in short-term growth may be weakening, at least temporarily. Apple, Microsoft, and Alphabet all showed similar patterns. Not dramatic declines, but choppy movement combined with unusual order flow. This happens when traders are unsure whether the next few days will bring clarity or chaos. When uncertainty appears simultaneously across several major companies, it's rarely random. At the same time, options traders increased their activity around these stocks. What's interesting is that the volume wasn't dominated by bullish bets or bearish bets. It was balanced, with a rise in both call and put contracts. This suggests traders are preparing for volatility rather than picking a direction. When options volume behaves like this, it usually means something is coming. It means the next move will be strong enough that traders want protection or leverage before it happens. Another clue appeared in semiconductor stocks. These companies often act as early indicators for tech momentum because they supply the hardware that powers everything from smartphones to cloud computing to artificial intelligence. Today, semiconductor stocks displayed weakness even when the broader market showed strength. When the companies that sit at the foundation of the tech ecosystem slow down, it raises questions about the sustainability of the current rally. Meanwhile, yields in the bond market made a sudden shift. Tech stocks are extremely sensitive to changes in interest rates. When yields move higher, tech valuations become harder to justify. When yields fall too quickly, it can signal fears about slowing growth. The shift in yields today created pressure on tech even without major headlines. It as a reminder that the market is still tied closely to expectations about future rate decisions from the Federal Reserve. Institutional investors also made noticeable adjustments. Large buy and sell orders hit the tape across different segments of tech, from cloud computing to consumer electronics. The key detail is that the orders were spread out over the day rather than concentrated at the open or close. This type of activity usually indicates portfolio rebalancing rather than panic. Rebalancing is something big money does when it expects the environment to change soon. Another warning sign showed up in market breadth. While a few big names stayed in positive territory, a larger number of smaller tech stocks turned negative. When a rally becomes too dependent on a handful of companies, it becomes fragile. It means that if even one or two leaders falter, the entire sector can pull back quickly. Today, the market showed early signs of that kind of fragility. There's also something happening with investor sentiment. Over the past few weeks, many traders became increasingly confident that tech would continue rising without interruption. But when markets become crowded with the same expectations, it doesn't take much to spark a reversal. Today's action revealed the first cracks in that confidence. Not enough to cause panic, but enough to warn that the next phase of the market could look different. Now, let's talk about the signal that ties everything together. The short-term volatility index started climbing quietly, just as tech stocks began showing hesitation. Historically, this combination appears before sharp movement. It doesn't guarantee direction, but it does guarantee attention. Big tech rarely flashes warnings without reason. And when it does, the market usually follows. Right now, the tech sector is in a delicate position. It doesn't mean a crash is coming, and it doesn't mean a rally is over. It means the environment is shifting. When the foundation of the market begins to wobble, even slightly, it often marks the beginning of a new phase in trading behavior. The next few days will play a major role in determining where the market goes from here. If you want to stay informed and ahead of these shifts, make sure you subscribe to Wall Street Market Brief. Every day, we break down the real signals hidden beneath the headlines so you can make better, faster decisions in a market that changes quickly. And if you found today's analysis useful, stay tuned for the next video, where we'll cover which tech stocks are still showing strength despite rising uncertainty.